Good Thursday morning, everyone. Thanks for joining us. And here we are. Dimitri, sorry about coming on late, buddy. It's a little lockup on the system.
No problem, Will.
How are you doing?
Good. You want to
start
do
with a disclaimer?
Okay. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need professional advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
Excellent.
And let me share my screen. If you guys are joining us for the first time and you have a question, you can put that question on the live chat on YouTube. Will's watching and he'll read it back to me. We also provide a link to Zoom. If you click on that link, go over to Zoom. You could ask your question live. Just click on button, raise your hand. We'll prompt you to turn on your camera. You don't have to turn on your camera. However, when we let you in, everybody could hear you and you can ask your question live and direct. While we're waiting for questions to come in, we'll take a look at the pre-market report, and I'll see, maybe I'll continue today on some of the stock volume profile, take a look at different types of trades that are going on in the volume. We kind of typically, people think of stock volume as just an aggregate, but lots of things are going on there. And when you dig in deeper, you could really slice and dice them up, and it tells you different stories. So we could continue on that. Also, maybe I'll take a look at maybe some SPY option strategy setups. Okay, well,
excellent.
Okay, so pre-market report. These are stocks trading in pre-market hours. We have our most active stocks, our biggest percentage gainers, biggest percentage decliners. Down here, I see 47 stocks made our percentage gainers list, 227 on the percentage decliners. So from this perspective, we're looking like a bearish bias at the open. Let's filter this list down to S&P 500 stocks. We want to take out all the small caps, ETFs, leverage products, all that stuff. Look at only S&P 500 companies. And I'm going to use the filter here in ETF, drop it down. You see a list of ETFs. When you select one of the ETFs, the list below gets filtered by holdings in that ETF. So SPY, let's click on that. That's the S&P 500 ETF. When you do that, you see that now the list below got filtered by stocks that are holdings in the SPY ETF, which are the S&P 500 constituents. And here we see two stocks made our percentage gainers list, 49 on the percentage decliners list. So from this perspective right now, we're looking like a bearish bias at the open, just like in the other situation. Let's see if I could, if there are no questions, maybe what we'll do is continue talking about, the different types of volume, different types of trades going on in the stock.
Perfect.
Sound good? So we talked about Netflix yesterday, and I was using Netflix as an example. And let me just go back to it. And just as a recap, we discussed during the course of the day, there are about 5 different trading sessions, right? We talked, there's trading going on in pre-market. We discussed how that's different from regular trading hours. There's also the opening cross, which is a single price auction. That's where the specialist is accumulating all the orders in the morning, and then opens up the book at an equilibrium price, and then regular hours start. There's also a closing cross, which are trades that need to get executed at the closing cross, or I'm sorry, at the closing price. And then we have after hours. We also discussed yesterday the difference between dark pools and lit exchanges. That's over here. We talked about how dark pools, they're private exchanges. They're run by broker dealers like Goldman Sachs, Citadel, Merrill Lynch, Knight. There are a lot of them, and they attempt to capture order flow, facilitate trades, and find liquidity without revealing the bid side or sell side of the orders until things get matched up. The lit exchanges, that's kind of, the last place to access that liquidity. Anybody could go there, high frequency traders and so forth. So we talked a little bit about this. I don't remember if we talked about trader size type, but there are different traders that participate in the market. We have small retail traders, kind of retail traders from, some are larger retail traders, some are smaller retail traders. We also have professional traders, and we have institutions. And professional traders would be, could be market makers, it could be prop traders, small hedge funds, and then you have very large institutions that pool a lot of money together, like big mutual funds and Vanguard and so forth. And they're all trading, intraday with each other. And this kind of tries to keep track of an estimate of the volume, the volume breakdown, right? The volume percentages by those types of traders. And we have an algorithm looking at those trades based on, size, distance by time between trades and so forth to get those estimates. Here, this here is comparing how the volume, the percentage of the volume in the dark pool, or the portion of the share of the volume that went into the dark pool versus the lit exchanges. So here we could see yesterday a bigger portion of the total volume went into the dark pool. So on average, it's usually 54%. Yesterday was about 58% of the volume, meaning there's a lot of liquidity matching up in the dark pools that did not have to go to the lit exchange. Okay. And here, this is showing us the percentage as of total by trader type. So yesterday, out of all the volume, institutions participated. Let's see here. What is that? 29%, almost 30%. And typically they're about 33%. So yesterday's institutional volume as a participation of the whole was down. Sorry, I think I have a cold.
Sounds like.
Yeah. Let me go down here and let's take a look at this. There are trades going on that have different conditions as well. And this top one, average price, you see there were two trades, average price, that were marked average price for 6.2 million. And this is typically what you see are these trades happen, after hours. Sometimes pre-market could happen. It could happen also during hours, but typically you see them after hours or maybe even pre-market, but usually after hours. And the average price, the assumption is that a firm was handling a VWAP order, and it could have been a day order, right? All day order. They executed that VWAP order throughout the day. And then at the end of the day, they put up this order on the tape because they have to give it back to the customer, right? So they're doing it on behalf of the customer, got the stock, then traded at the end. So we kind of get a glimpse of, what was going on yesterday. So we see here's the big one, for 5.8 million shares. The average price was 306 and 2 cents, traded after hours, 410.58. Okay. So maybe not very huge. I'd have to go back and look for Netflix if that's a very huge one, but gives us a sense of what kind of VWAP. And of course, this isn't all the VWAPs. There are a lot of different VWAPs in there that go straight to the customer, but this one, the assumption is that the broker was handling and then at the end of the day put up that trade to the customer. Okay. Then we see a small one here in a pre-market for 1,300 average price.
PD,
yeah.
Vlad is asking about what he's seeing on the screen. I know you talked about it yesterday. Just reiterate that this is your internal screen, and you will be releasing it at some time. Maybe you can let everyone know when you think it will be released to the public.
Yeah, so this is my internal screen, what I use when we create new features and products. I do a lot of the testing and trying to, organize it in a visual way that will make sense before we push it out. So this isn't quite ready. The reason I'm going over it is because I think we had some questions 2 days ago about the volume. So I just wanted to maybe just go over the different types of volume, the breakdowns and how they're tagged. But I just realized that this has not yet been pushed out. Okay, so it's not yet available, but I think it's worth just going over it. So when it does become available, you guys start using it, you'll have a sense of what's going on. All right, because you probably, most likely, I would say most of you would be seeing this for the first time. Right? That's what I think. Most of you will probably be seeing these things.
I think yesterday was the first time you showed it, and Rob actually brought up on yesterday's show.
Yeah, or just in general, because what you would have to do is really go in there and break down that tape and study it, and there's lots of stuff going on there, and this is hard to even explain. And I think a lot of you would probably be seeing this for the first time ever. Derivatively priced trades, kind of similar, that they put it up with some kind of, something else attached from a derived value, right? That one, I'm not even sure exactly what the derivatively price, because I didn't have any kind of, I've never used that. I've never used that order type actually. So I think I'm going to skip on that explanation. You could go try to read it, but since I never really had experience with it, I'm just going to stay away. There are certain times when people need to settle it same day or next day. It's not as important, I think, for analysis, but sometimes when you're creating or redeeming units or shares of funds, you might have to do it same day settlement, sometimes next day settlement, depending how you're creating them or redeeming them. Okay. Contingent, this one is based on you're executing the shares contingent on doing something else. It could be like an option or another stock. So usually what we see it is, like somebody does a buy right. So it's a stock trade that's tied to an option. That would be contingent. So the stock trade is contingent on executing an options trade at the same time. It doesn't have to be an option, but usually that's what we see, that it's contingent on an option, but it could be also contingent on a basket of stocks. It could be, it could be contingent on just a pairs trade. It doesn't have to be options, but at least the way I've used it in the past, I've always looked at tied to options. Okay, so when I've used it, I always look at, has there been an options trade at that moment? So if we go over here, look up contingent trades, you can see some of them are small, right? Some of them 36 shares, 8 shares. Would be a person just doing, some kind of an options trade. Who knows? But here we got 1,000 shares. Let me see. Like here's a big one, 10,000, right? At 11.18. So that one I'd probably go look at the option block trade screener and see if I could find a contingent option if I'm curious about that trade. All right, but about $14.6 million worth of shares traded with that were contingent. This derivatively price.
Hey, D.
Also, yeah.
Rob is asking, is there a relationship to the size and flow of the dark pool and the future rise or fall in a stock or ETF? Is there any testing that's done on that?
I mean, I didn't do testing on that, but if you're, all right, let's do an inference, right? If an inference is this, if you're seeing something moving and it's all going to the lit exchange, right? It's all going to the lit exchange. The inference is that there's nowhere to get that liquidity except the lit exchange, right? They're not, whoever's buying or selling the stock, they can't find it in the dark pools. They can't get matched up. They have to go and get it in the public markets. They have to take the resting orders because the lit exchange determines the market price, right? The MBBO determines the market price. And if you go to the lit exchange and start lifting the order book, it's going to move the markets, right? You start moving that limit order book and the markets are going to move in, because you're taking it away. So the inference is that if the markets are moving with less dark pool participation, then those orders are having a hard time perhaps finding liquidity, and they're forced to, they want the stock and they're forced to go grab it on the lit exchanges. Okay, so that's basically the way I would look at it. But then again, yeah, sometimes when you start looking, I'm hoping to push this out for you guys. The thing is, when I push it out, I want to do it in a way that, it will be useful to you so you can understand it. But, I've also seen situations where I've seen a big trade go up in a dark pool, like a very large trade, massive volume, but that kind of completed the order, right? And then you saw the market reverse. So somebody's looking to buy stock, for example, and they're looking for it. They're forced to kind of push up a little bit the markets on the way up with on the lit exchanges. All of a sudden, they get to a price where their order is filled, they're complete in the dark pool. They found that liquidity, and they might be, and at that point they're done. And all of a sudden, you start seeing the market coming back in. So it's really a lot of things you have to start to look at to form an opinion. And again, it's not a definite. You're just trying to look at the data, look at the surrounding circumstances and make an assumption what's going on. Okay. Let me see, where was I here? Okay, down here, the derivatively priced, and if somebody knows what this is, if you guys used it before, like, please tell us. This is something I'm not very familiar with. I do know that there are times where certain institutions buy a basket of stocks. Okay, so they'll ask for a quote, and they do a basket of different stocks. In other words, if they'll call, let's say, broker dealer and say, I need to sell this, and this stock, like say 10 stocks, and where can I get this done? And then they give them a price, maybe notional, whatever, that all 10 stocks, this amount will do that, this price. The whole basket goes up. And then I think maybe that one, at that point, maybe this is how it gets marked as derivatively priced, right? Because the whole thing, it was part of derived from a basket. Okay. So that might be it. But this one, again, I'm not super sure. And then you got this next day in delivery price. This last one, volume bursts, this is something we derive. Okay. And the way we define a volume burst is we look at the tape and we look for very large trades. Let's go over here. And the large trades could be in the dark pool or the lit exchange. Okay. We look at both. And we make sure they're sizable trades, so we exclude anything that we would consider small retail, professional. We only look at the very largest trades. And out of those large trades, we keep track of them. And then we look at the extremely large volumes based on the average. So we take the average large trade, and then we say, well, show me those that the volume is 3 standard deviations above that average. Okay, so if, like, for example, in Netflix, a large trade, a typical large trade is $500,000. Okay, and that's the average of a large trade, and a standard deviation away from that is, I don't know, let's say 100,000, right? So we would take 300,000, 3 standard deviations, add that to the average, and say, show me all the trades that are above $800,000 in notional. Okay. So these are right here. These are the very biggest large trades, right? That would be unusual even for a large trade. Hopefully that makes sense. Now, a large trade in our eyes can happen in 2 ways. One is a block trade. So somebody just matches up. Let's say, somebody's trying to buy, $2 million worth of stock, and then they find somebody who wants to sell $2 million worth of stock, and they match up at one price. That's a single trade, right? A lot of them, they're called block trades, a single big trade. But there are other times when the big order can't find another block, right? They can't find that liquidity, and it doesn't exist on the lit exchange, on the limit order book. It doesn't exist in the dark pool. But what they do see is that there's enough on the limit order book, enough different orders sitting on the limit order book on, let's say, New York Stock Exchange, NASDAQ, BAT, SIBO. They calculate, and there's enough there to get what they need, right? And it could be a high frequency trader. It could be just a big firm. It could be a VWAP order that grabs it. But what happens is that they'll grab it really fast, right? So they're not going to pluck at it 1 second at a time. It's really fast, usually happens within a second. It could be, I'm sorry, within a millisecond, it could be within 2 milliseconds, 3 milliseconds, but it's really quick. And we track that too. Okay, so we consider that a burst trade. So you could see here in Netflix yesterday, these were all burst trades that were on. Let me see if I have them down. So these were all burst trades here that involved more than a single trade. This one was 3, so it's almost a single trade. And these are the amounts for 1.9 million, 2.7, 2 million. So these were yesterday. I don't know, what do I have, like 6 in here, 7 big burst trades. And we keep track of those to see what's going on with them, right? What are they trying to do? And to see what they're trying to do, we need more clues. And to get those clues, then we got to look at the tick data and the price impact of those trades. Okay, so now that we detected the volume and we see the magnitude of the trades and we see the time that these trades occurred, we got to go to the VWAPs and see, well, where am I? Down here, what happened at that time? So let me see. Which one was the first one? Hold on, guys. Let's take a look at what, 954. Okay, so 954 coming down here. So let's see what happened here. So at 954, okay, that's over here. We saw that a very large trade. So you see within the volume, even though the volume ticked up, we know that a very large trade happened in there at that moment, right? And this is what we see, that the VWAP ticked up, right? So what does that mean? The minute before, the volume weighted average price 306.27. The next minute on this big burst, the stock ticked up to 306.33. The assumption is that it had to be a bigger buyer than a seller, right? Because the price got pushed up on higher volume. So somebody, the assumption, remember, the inference is that somebody stepped up, right? Stepped up to grab it, and then we could see like what happened to the stock afterwards. All right. So that's kind of, we take the volume, that's unusual, and then we look back at the price impact of that volume to get a clue what we think just happened. Does that make sense to everybody?
Yeah, seems to.
All right. Well, we're right up at 9:30, Will. So I'll let everybody go. A reminder, tomorrow we don't have the regular morning show. We're going to start it up Monday. We've got some personal things we have to take care of in the morning. So no show tomorrow, but we're starting Monday regular hours.
Perfect. And then we'll be here Monday and Tuesday, and then I leave for Thanksgiving. So rest of the Thanksgiving week will be up. What do you think the number one pie for Chameleons is? Thanksgiving
The number
pie.
one. The number one what?
Pie.
Pie.
Like apple pie is, America's pie, or so people say.
Oh.
Actually, I won't tell you. We'll save that for Monday's show. Pre-Thanksgiving show. We'll poll all the Chameleons for their favorite pie. There was a little bit of a discussion of it today. Thanks, Dee, for everything. It's great.
All right. Thanks, everyone. Stay safe out there. Have a great weekend. Have a great trading day, and hope to see you guys Monday.
See you guys on Monday. Have a great day, everybody. Bye.